While I usually don't comment on pending legislation, it's important to note that Bernie Sanders has introduced an act called the For the 99.5% Act, which shows some of the potential Democratic proposals we could have coming up for estate gift and GST taxes. Now, whether or not these are adopted is up in the air, but it's important to kind of get a sense of what could change in the future. This is part one of a discussion of this act. So, some of the most significant changes are going to be one, a reduction of the applicable estate tax exclusion to 3.5 million from its current high of 11.7 million. Another will be the reduction of the applicable gift tax exclusion for lifetime gifts to $1 million from 11.7 million, with some clarifying changes to the gift tax annual exclusion as well. We'll also see an increase in estate and gift tax rates that apply to amounts in excess of those exclusions, and also a clarification of the step up in basis for assets in a grantor trust. There's a number of other proposals out there which we'll cover in a later part or episode dealing with things like grantor trusts, grats, the GST tax in a dynasty trust, and even valuation discounts. And those will be pretty significant if adopted and will require reactive planning. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. Today's episode, episode 172, is entitled For the 99.5% Act, Part 1. This is the first of a series of discussions on Bernie Sanders' estate and gift tax reform proposals. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you'd like a copy of these slides, you can email me at griffin.bridgers@gmail.com. So let's dig into the act. While the chances of this being passed seem to be a long shot, this does at least set the stage for a mystery we've seen a long time as to what are the specific Democratic proposals going to be for any reform to estate gift and generation skipping transfer tax laws. Now, if most of these are adopted, it's going to be the most comprehensive change we've seen to transfer tax laws in 20 years. But even if this is not passed, which is more likely it seems, it's important to note what might be coming down the pike, because there's a little bit more beyond just simple changes to the estate and gift tax exclusions that one needs to note. Especially because in the last couple of years, a number of irrevocable trusts have been set up in order to avoid gift, estate, GST, and even income tax. Those could be under attack, as well as entity transfers where a valuation discount is claimed. So, the biggest change, at least in terms of the context of what's being discussed out there as the political plaything for tax reform, is a change to the estate tax and the gift tax exclusions. Now, currently, the estate and gift tax exclusions are unified, meaning that they're the same. Anything that you use up as a gift or estate tax exclusion during life reduces the amount available at death. But what this is going to do is decouple these two exclusions, as it was prior to 2010. The estate tax exclusion is going to be reduced to $3.5 million, and the gift tax exclusion is going to be reduced to $1 million. Now, the gift tax exclusion only becomes a concern to the extent your gifts exceed your gift tax annual exclusion in any given year. Now, what that annual exclusion is currently $15,000 per donee for present interest gifts. And I discussed that a couple episodes ago, but what's going to happen here is that the annual exclusion is going to be simplified. The amount isn't going to change. This is still going to be currently $15,000 per donee, with inflation adjustments in increments of $1,000, which usually happen every few years or so. But this will be simplified to apply to all transfers and not just gifts of present interest. But the donor and not the donee is going to be restricted to 2 times their annual exclusion for certain types of gifts. Those will include transfers in trust that are completed gifts, presumably. It will also include transfers of interest and pass-through entities, which notably it doesn't include C Corps. It will include transfers that are subject to a prohibition on sale, and also transfers which cannot be immediately liquidated by the donee, ignoring withdrawal and similar rights. So that will gut crummy powers and crummy rights as well. So that'll be a pretty significant change when it comes to funding trusts and using the gift tax annual exclusion incrementally over time. The estate tax rates are going to be changed as well. For amounts over the exclusion of $3.5 million, but under $10 million, you're going to have a top rate of 45%. But we're going to have three new brackets introduced. One applies for estates in excess of $10 million, which is a 50% maximum rate. For estates in excess of $50 million, we're going to see a 55% rate. And then finally, for amounts or estates in excess of $1 billion, we're going to see a 65% maximum rate. There's a couple changes that will be beneficial and will benefit certain taxpayers, including an increase in the maximum value reduction you get for special use valuations on family farms or real estate that's used in a closely held business. That reduction is going to be increased to $3 million. So what that means is that if you have, say, farmland and the appraisal comes back valuing it at its highest and best use, you can reduce that amount by up to $3 million to take into account the value of the land in its current use as a family farm. Similarly, for conservation easements, which are recently very highly used in the area of family farms, you're going to see an increase in the maximum value reduction to $2 million. So with family farms, that's going to be a huge benefit, especially with the reduction of the estate tax exclusion amount, because you'll still get this double dip of the special use evaluation or even conservation easements, because these two areas really highly affect family farms. Now, ironically, there's this favorable treatment of conservation easements here, but it's coming on the heels of a number of attacks that have occurred with respect to conservation easements by the IRS over the last couple of years. Now, one area that's being clarified is the step up in basis and how it applies to grantor trusts. Now, really outside of this, there's no change to the step up in basis. It's still going to apply to assets that are included in the gross estate for estate tax purposes. But a number of practitioners have been split on their opinion on whether or not assets in a grantor trust get a carryover basis or a stepped-up basis at the grantor's death. Because at the grantor's death, for income tax purposes, the trust is created at that point, and a number of more aggressive taxpayers have taken the position that when the grantor dies and the trust is deemed created for income tax purposes, that's technically a transfer from a decedent, which would qualify for that step-up in basis. But the Act is going to clarify that that's no longer the case. It's going to be a carryover basis rule unless the grantor trust assets are included in the grantor's gross estate, in which case you do get a step up, but in all other cases where there's no gross estate inclusion, there will not be a step up in basis. So that was, in the eyes of a lot of people, that was the rule before, but this just really clarifies that. And there's going to be a number of other changes too with respect to grantor trusts that are really going to gut your ability to use those. But that is a discussion for another episode. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. And stay tuned for part 2 and part 3 potentially of this series on the For the 99.5% Act. Thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.